Everyone thinks Nike is failing because their designs got boring. They're wrong. Nike didn't lose its edge on the drafting table. It lost it in the boardroom. This is a story about a structural corporate disaster called consumer direct acceleration. Over the last few years, the single strategy wiped out over $50 billion in market cap because leadership prioritized theoretical profit margins over actual market presence. Today, we're breaking down the financial mechanics of this failed direct-to-consumer pivot using the latest Q2 FY 2026 data. You'll see exactly how exiting wholesale channels created a vacuum that competitors like Hoka and On were waiting to exploit. Let's look at the math that broke the swoosh. In 2020, Nike launched the Consumer Direct Acceleration Plan. The objective was aggressive. Cut out the middlemen like Foot Locker, DSW, and thousands of independent stores to capture 100% of the unit margin. The logic was seductive. If a pair of shoes sells for $150, why let a retailer take a cut? If Nike sells it directly, they keep the full amount and theoretically own the customer data for life. Executive leadership operated on the assumption that Nike's brand equity was so dominant that it could dictate where consumers shopped. They believed that if they pulled their sneakers off physical shelves, customers would have no choice but to migrate to the SNKR app in Nike.com. It was a calculated bet on owned inventory over the breadth of physical distribution. Consequently, Nike severed ties with over 50% of its retail partners. They didn't just reduce inventory, they effectively removed their products from the daily routine of millions of shoppers. However, the financial model had a fatal flaw. It ignored the massive spike in customer acquisition costs required to replace that lost volume. Retail partners provide free foot traffic. Foot Locker pays the rent at the mall. They pay the staff to show the product. When Nike cut them off, they had to spend heavily on digital advertising to acquire the same customer who used to walk past their shoes for free. Suddenly, that extra margin was being paid directly to Meta and Google. Furthermore, the operational costs of direct-to-consumer are punishing. In the wholesale model, Nike ships massive pallets to distribution centers, which is highly efficient. In the DTC model, they must pick, pack, and ship individual boxes to individual homes. This last-mile delivery cost, combined with the industry-standard return rates of 20 to 30% for online apparel, completely eroded the gross margin gains they promised to investors. This move also fundamentally misunderstood consumer psychology. It assumed every purchase is intentional, but in reality, shoe buying is often about discovery. You go to the store to look around, you see something cool, and you buy it. By removing themselves from the environment where discovery happens, Nike didn't shift the purchase online, they just deleted it. They optimized for a transaction that never occurred, leaving a massive opening for anyone willing to fill that empty shelf space. The irony is painful. In their quest to keep all the profit, they ended up paying more to sell less. While Nike was busy pouring billions into supply chain logistics and app development to support its new distribution model, something critical began to rot inside the company: the product pipeline. R&D budgets relative to revenue stagnated. The company became so obsessed with how they sold the shoe that they forgot to focus on what they were selling. This created what we call an innovation vacuum, and it's the primary reason you see those thick-soled Hoka shoes everywhere today. You have to understand the mechanics of physical retail to see how this happened. We call this the shelf space concept. A retail store, whether it's a massive Dick's Sporting Goods or a local running specialty shop, is essentially real estate. The store owner measures success by revenue per square foot. When Nike made the corporate decision to pull their product from these retailers, they didn't just hurt the retailer, they created a desperate need for that retailer to survive. The store owner looked at their empty wall space, which used to hold the Nike Pegasus or the Air Max, and needed to fill it immediately with a brand that could convert customers. This is exactly where Hoka, owned by Deckers and On Running, stepped in. They didn't have to fight Nike for that prime shelf placement. Nike voluntarily gave it up. Hoka and On utilized this opening to secure prime placement in running specialty stores, which are the influential hubs of the running community, and eventually big box retail. Hoka capitalized on the maximalist trend. They offered functional comfort that looked completely different from anything else on the market, while Nike was still iterating on sleek, low-profile lifestyle silhouettes like the Dunk and the Air Force One shoes designed for fashion, not function. Hoka went the other way. They built massive cushioned soles that prioritized utility. At the same time, On Running leveraged its Swiss engineering branding to capture the premium performance demographic. They marketed their cloud tech technology as a serious tool for serious runners, effectively stealing the performance halo that Nike had owned for decades. The data confirms the damage. During the period Nike was restricting supply, Hoka and On saw double-digit and triple-digit revenue growth periods. Nike's running category, historically their fortress, flatlined. Here's the vignette that explains the cultural shift. For the last decade, Nike optimized its business for the sneakerhead. This customer buys based on scarcity, hype, and resale value. They wait in line on the SNKRS app for a Jordan 1 release. But the market shifted post-pandemic. The consumer moved from sneakerhead culture to performance culture. People wanted shoes for walking, running, and nursing shifts. Utility, not hype. Because Nike had spent years focusing on the scarcity model, they were left holding millions of dollars in inventory of hype products that nobody actually wanted to run in. They lost the daily utility customer to brands that were simply available on the shelf when the customer walked in. Now we need to look at the scoreboard. Theories are interesting, but the P&L statement is the only truth that matters in this business. We are going to analyze the current financial damage using the latest Q2 FY 2026 reporting. And the numbers paint a stark picture of a strategy in retreat. First, look at revenue and geography. Total revenue came in flat at $12.4 billion for a growth company priced like Nike. Flat is a disaster, but the real crisis is regional. Revenue in Greater China collapsed by 17%. This is critical because for the last 10 years, China was the growth engine that subsidized slow growth in North America and Europe. That engine has stalled, signaling a massive loss of regional dominance to local Chinese competitors who are following the Hoka playbook. Next, we have gross margin compression. Margins fell to 40.6%, down 300 basis points year over year. In the shoe game, a 300 basis point drop is massive. This was battered by two main factors: new tariffs, which increased the cost of goods sold, and the desperate need for heavy discounting. Because the direct-to-consumer channel slowed down, Nike was left with bloated inventory that they had to liquidate at markdown prices, crushing the profitability per unit. The most damning metric, however, is the channel mix reversal. This is the proof that the consumer direct acceleration strategy has failed. In Q2, Nike direct revenue, the channel they spent 5 years and billions of dollars trying to build, fell by 8%. Meanwhile, wholesale revenue jumped by 8%. This is a complete reversal of their stated goals. It proves that the pivot back to retailers isn't just a strategic adjustment, it is a desperate necessity. They are crawling back to the partners they cut off because they cannot move enough volume on their own. Then there is inventory and turns. Inventory sits at $7.07. While this is down 3% year over year, it remains historically elevated. High inventory kills pricing power. When you have nearly $8 billion in shoes sitting in warehouses, you cannot command a premium price. You are forced to run promotions, which trains the customer to never pay full price for your brand again. Finally, look at SG&A and demand creation. Marketing spend rose 13%. Think about that relationship. Revenue is flat, but marketing spend is up double digits. This is the tax of losing your organic visibility. Nike is now attempting to buy back the visibility it voluntarily surrendered when it left the wholesale channel. They are paying more to achieve the same result they used to get for free. CEO Elliott Hill's new Win Now strategy is effectively a public admission of the previous regime's error by aggressively restocking the very wholesale partners they previously cut off. Leadership is acknowledging that the walled garden strategy didn't just fail, it actively strengthened their enemies. The scoreboard for Q2 FY 2026 shows a company that is no longer attacking, but scrambling to defend the empire it spent 50 years building. The counterintuitive lesson for sports executives is that optimizing for margin often destroys market share. Nike proves that channel control is worthless if you lose the physical ubiquity that keeps a brand top of mind. Innovation requires competition, and isolating your brand in a walled garden simply invites disruptors like Hoka to take your spot. If you want to understand the real financial mechanics of the sports industry, hit subscribe and check out this breakdown video next.